Hi friends. Many investors are wondering where to go. Stocks, bonds, cash, underneath their pillows, commodities, gold, metals. Where should investors go? A lot of that depends on your time horizon, your ability to take on risk, but also what you're trying to generate from your portfolio. So maybe we can look at the difference between stocks and bonds, particularly in this economic moment. You know, when you invest in a company, let's say there was a local smoothie shop in your area, and you gave the owner $100,000 and he gave you 10% of the company. Well, in a month, in 5 days, in a year, in 10 years, that company could go out of business and you've lost your investment. Now, let's replay that scenario just with a slightly different form of investment. Let's say instead, when that smoothie operator asks for that $100,000, you actually say, I'm happy to give it to you, but I don't want equity in the company. I want you to take your assets, your smoothie machines, your countertops, your inventory, your brand, whatever it may be, and I want to secure my investment with your assets. That's the difference between a stock and a bond. A stock is simply an investment into something that could go to zero or could go to infinite return, but you don't know. A bond is an IOU note that's actually backed by something. Depending on what type of bond it is, it could be backed by the credit of someone, it could be backed by a tangible asset, you could be first in line, second in line, it could be mezzanine debt. There's all different sorts of debt and IOU bond or fixed income instruments. But here's why this is really important, especially in a volatile market. Bonds are negatively correlated to interest rates. So as interest rates rise, the value of bonds go down. Well, we just experienced a Federal Reserve that raised rates over a 12-month period faster and more quickly than any other Federal Reserve in history. So bonds in 2022 had their worst performing year. So now bonds are, depending on the type of bond, 5, 10, 15, 20, some bonds are even 30% below their value a year ago. Here's the interesting thing about bonds though. They have a maturity price, meaning if you buy a bond today that has 5 years left until it matures, we know what it matures at. It matures at 100 cents on the dollar. So if you buy it today for 75 cents, as long as that company or municipality or entity is still in existence in 5 years and solvent, you just made 25% because you bought it for 75 cents and it matures at 100 cents on the dollar. Oh, by the way, you collected an interest rate each of those 5 years as well. So right now, we're starting to see opportunities in fixed income and bonds that we haven't seen in a long time. If you're a client of ours, you've started to see a lot more activity in fixed income instruments. We think for lots of investors, not all investors, but lots of investors, that fixed income instrument provide more risk-adjusted returns over the next 12 to 36 months than most other asset classes. So when you're thinking about stocks versus bonds, one has a greater upside but a greater risk profile. The other oftentimes is just a math equation. Now, like any good investment, we never want to over-allocate to a particular type of investment, but we think fixed income, in particular, discounted fixed income instruments, are starting to make a whole lot of sense for investors. Thanks for watching. I'll see you next time.